Hey, hello America. How you doing? We've got Non Farm Payroll coming up in a few short minutes. You should be able to see my screen. And what I want to do is I'm going to trade the what's called the rule of 4. But let's just get the numbers out and then there will be time to discuss what rule of 4 actually is. So we've got 1 minute left. So here we go. Okay. Not any clear direction, it seems. I'm not actually. So we get not really a rather muted response, it seems. Now we're going. Well, as you can see, there isn't actually that big a response to the non-farm payroll release. Okay, so while we are waiting, let me just go through the simple rules of Rule of 4. So here's a charting package. And what I want to do is I want to take you through what the Rule of 4 really is all about. So what you're seeing here is the Non Farm Payroll release on the 2nd of August. And this is a 5-minute chart. And if I create an, where is it? There it is. If I create an arrow, and I get rid of the crosshair, maybe it'll be easier to follow. So this bar here is the release of the non-farm payroll. And essentially what the Rule of 4 says is that when it's a pre-market news release, you count 1, 2, 3, 4 bars. And you take this 4th bar here, and the theory is that the market will have had time to assume which direction it wants to move, and then you will be a buyer above with a stop loss below, or you will sell short below with a stop loss above. So here, you obviously don't want to put it exactly below, so you probably want to put it a few points. So you just got away with it here. You probably got filled here. I wasn't trading it in August, and you had a relatively decent move into the open of the US markets. If we go to the next release, which was on the 6th of September, I got a bit too far there. So on the next release in September, again, I'm going to draw an arrow. We had the release. That's this bar here. Just going to double check that is. Yep. And then you count 1, 2, 3, 4. And that means you want to be along above this bar here with a stop loss below. And conversely, if that was to give you an opportunity to go on the other side later in the session, you sell short here with a stop loss here. And finally, if we go to the 4th of October, so the story behind Rule of 4 was it's actually something I invented to trade the FOMC statement. Where are we? 26. 4th of October is coming up. Here we go. No, did I go too far? Yes, I did. 4th of October. And it was trading at 42,000 at the time. So here we go. So again, I'm going to draw an arrow. And just remember, this is not, I haven't sought out any sort of pre-selected days. I'm just showing you the latest news releases. There's 1, 2, 3, 4. So you're long above with a stop loss below. And if need be, although you probably want to try and avoid the open. But anyway, you certainly do have the opportunity for a decent trade here of about 75 Dow points at its best. Does it work in the S&P 500? Well, we can have a look. Sorry about that. I just need to close some trades that I have running. There we go. Okay, so we had the 4th of October. Okay, so I still have to scroll a little bit. Sorry about that. So now we're just testing it in a different index to see can it be used. So here's the 4th of October in the S&P 500. Again, I'm going to draw an arrow. So here's the news release, the non-farm payroll. 1, 2, 3, 4. So you buy above. If it helps, I can draw in some lines for you. Basically be long above and short below. And of course, this research is based on, maybe this is the point where I just go on camera. Can I? Yeah, I can. So this research is based on a real deep analysis of stock indices' behavior around a news release. What's ideal, let me just pause for a sec. I invented this idea because I wanted to trade the FOMC announcement. If you don't know what the FOMC announcement is, essentially an announcement that is released during the trading day. Non-farm payroll is released before the trading day starts. And let me just be clear about one thing. What do I mean by the trading day? Well, I know that most markets are 24-hour evolving markets, but there is such a thing as the ringing the bell at the Nasdaq exchange or the New York Stock Exchange. And that's what I call the opening of the trading day. Yes, sure, there's trading before that and there's trading after that. But for the purpose of what I'm trying to illustrate, that's the beginning of the trading day. So if you're sat in New York, that's going to be 09:30 in the morning local time. But if you're sat in, say, Germany, that's going to be 15:30 in the afternoon for you, and so forth. And so the non-farm payroll news item, I have now been I think I must have, well, there's 12 non-farm payrolls a year, and I've been trading for 25 years. So 12 times 25, what is that? 300. And is that right? Yeah. Can't believe that I double checked that. I usually am really sharp with that. So I must have witnessed, maybe I missed a few. And it occurred to me that the FOMC announcement, and the difference between the FOMC announcement and the non-farm payroll announcement is that non-farm payroll is released before the stock market is open, whilst the FOMC, the Federal Reserve interest rate decision, is released while the market is open. And when I started trading, I listened to experienced traders talk about, oh, there's always going to be a fake out in the FOMC. So if they wanted it to go up, they will first take it down. So that's, well, when I worked on the trading floor, we used to say they're taking it down to get rid of the weak hands, or they want it down, so they're just gonna push it higher first, and then they'll pull the rug underneath all the longs. And I thought there has got to be a better way of doing that than just to come up with some plausible or unplausible. So it's a bit like, buy low, sell high. Great, but what defines a low? Low could easily go lower, and why would you sell a high? It could go higher, and so forth. That's why I coined the expression buy high and sell higher, or short low and cover even lower. And so I downloaded all the FOMC announcements that I could get hold of. Now, there's not an FOMC announcement every month, but there are, I believe, about 6 a year. And I'm not talking about the ones where they just release the minutes. I'm talking about where there's a news release and then a press conference. Although the press conference is a sort of a relatively newer thing than it had been. You know, everything evolves, and this including also does evolve. And so what I found was that if I was trading the FOMC announcement on a 10-minute chart, then there's one particular candle, and I'm not being coy here, but rather than me just trying to tell you which candle that is, maybe I want to urge you to go to my Telegram channel, my resource channel, and then you look for the data. It's all free of charge. There is a particular segment called Rule of 4. But then someone said to me one day, hey, you know your Rule of 4, which by the way has got a 100% track record. I have never lost after using Rule of 4. Oh, I have lost on FOMC, but after I started using the Rule of 4, I have not had a losing trade on FOMC, which is a pretty good track record. And then someone in my Telegram channel asked me, have you ever used the Rule of 4 on news releases before the market opens? And of course I had to say, no, I haven't actually done that. And I started doing the research, and I tongue twister, I very quickly found out that I wasn't able to use the same time frame on pre-market news releases than I did on, say, central bank decisions or announcements. But then I changed the time frame, and I started counting not the fourth 10-minute bar, but the fourth 5-minute bar. I just gave you a clue what the FOMC time frame was, didn't I? Not that I was ever trying to hide it. I'm just saying it's the fourth 10-minute bar. So here, but you know, let's look at S&P in September. So that was on the 6th of September we need to go to. Coming up, there's the 6th of September. So here's the 6th of September, and here's the news release. I'm going to draw a pointer again. So here's the news release. 1, 2, 3, 4. Long above. This one is more dubious because you sure as you're not really getting much bang for your buck here, are you? You get the joy of sitting for the next very long time. Your stop loss is down here, and maybe with a bit of luck you moved your stop loss up because you were after all in profit by about 12 or 13 S&P points. And then down here, well, you have an opportunity to sell short. So I won't do any more because I actually quite like to watch the real market. 1, 2, 3, 4. So that means that the Dow Jones is now along here at 42,000. So that would mean that I would be a buyer here. Well, I'll do it right now or not, or am I just teaching this? But anyway, that's what I would be doing right here. Long above. Can you use it in the NASDAQ? Yes, you can. So it'll be 1, 2, 3, 4. Hang on, did I count that right? I think I did 1, 2, 3, 4. So right now it's long above here, which is at 20,015. And just bear in mind that I trade an instrument called CFDs, and it's more like a cash-based instrument than it's a future-based. But anyway, you should still see the same kind of candle formation, even though if you're using a September contract. So the Dow is doing really well. I'm ashamed to say that I'm not on board, but that's sometimes what happens when you're teaching as opposed to trading. And then I would have the stop loss down here. Now you might say, well, it did just go below, and that's why it's very important to decide what's my offset gonna be, because this is the bar 1, 2, 3, 4. So you would be long above and short below, but I wouldn't want to short the second it went 1 point below. I quite like to have an offset of about, in the DAX I usually use an offset of about 5 points. So 5 points below or 5 points above. So maybe with the Dow I would use a bit more, or I just got lucky and I only started seeing it when it was already up here. I would also consider flipping the switch if the stop loss is not too big. And in this case, a stop loss in the Dow of about 25 points, it's actually very, very reasonable. And then the point here of this exercise is essentially just try and get that stop loss up to break even as soon as possible, and then try and hold it into the open, because what tends to happen at the open is that the market will go and that's just the nature of the open, especially after a non-farm payroll. But if something like this, and you had been bought here at 5 and you had about 20 odd points in profit, well, maybe you would want to move your stop loss up. I'm not going to be the arbitrator or the decider of where you put your stop losses up, but that's just how I like to trade. Well, ladies and gentlemen, that was a brief explanation of what the rule of 4 is. I will stop streaming, and I will see you for the US Open in about 30 minutes. Thanks a lot. And click the wrong button.